Hello again all. Les here with volume 2 of the Volatility Master Settings series. That sounds exciting. On this one, we'll go through a few more settings and probably double up on some of the settings from the first video that I feel are or feel require mentioning again, just so everyone understands. I'll just share my screen and we will get into it. Alrighty, back to where we were at the end of the first video. Alrighty. Just quickly, we've talked about what daily profit target was and what the daily equity protection was. Now, everybody's free to experiment and backtest and do what suits them personally. But I think it's important to have a positive risk to reward between these two. So in this instance, on a good day, we would make $3,000. On a bad day, we would lose $1,500. So if we have one winning day and one losing day, we would still be $1,500 in profit. Another thing to remember is if you, let's say you have a $150,000 account, that would mean $1,500 would be 1%. Now, we also have our trade size set at 1% risk. So that means if we lost one trade, we would also hit our daily equity protection, and therefore no more trade would be taken out for the day. I'm not saying that's the wrong thing to do, but it's just something to keep in mind. And personally, I like to have a setting that's probably closer to 2 times that. So if I wanted to risk 1% per trade, I would have my daily equity protection set at or close to 2% of my account balance, meaning that I'd have to lose 2 trades in a row in order to hit my equity protection. And that gives the software and the markets, or the software, a chance to catch a better trend on the market and make up for that first loss. So if you took one loss, you'd only be halfway to equity protection. And then that second trade, you would have a good chance of catching a nice bit of a trend and making up for that first loss with some profit on top, and hopefully all the way through to the daily profit target. Otherwise, if you lose most of your equity protection leeway on that first trade, it may still be able to open up a second trade, but the market would only have to move a small distance before you actually hit your daily equity protection, and it would be closed out. So it wouldn't really be a good chance to make up for that first loss. And I mostly just mention that so you can fully understand the implications of whatever settings you choose to use there. We talked about the stop loss in points and the fact that it's going to, in this case, place a stop loss 50 points, which is 5 pips, above or below the range. Okay. Now, as with everything, you're free to choose what would suit there, but my way of thinking with that setting is that okay, so that's 50 points above. Okay, so just a nice little bit above. You don't want to have it below, preferably, or you don't even want to have it too close, because the idea is that is essentially resistance or the top of the range. If the market was to go above that, then there's a fair chance the market is starting to go up instead of continuing to go down. But you also want to have enough leeway so that you don't just hit it and then have the market go the other way. And on gold, through use and back testing, I have found that 50 points works out the best on average. That will be different depending on, if you're trading different pairs. I use 50 points when I'm talking about the US 30, not with gold. Because all of the settings I have here are the default ones, which is US 30. I just happen to have a gold trade up, so I confused myself. So 50 is what I use for US 30 and is what I've found to average out best. The maximum stop loss, the reason for that setting is that it's possible that depending on what the market's done, the range, so if we measure the distance between the bottom and the top of the range, that is 840 points. Now, if the software placed a sell order, it would place it about here. So, it'd have to break below. So it'd place the sell order about there, and it would place the the stop loss a little bit above the range, so about there. And that is 940 points. All right. And in this case, we've got the maximum stop loss set at 1,000. So if for some reason the range was a lot more than that, then the range, the stop loss distance would be trying to set, a long way away. So it'd be much further, which you may not want, although it's generally a good idea to make sure it is on the outside of that range. But sometimes you might have an excessively large range and you don't want your stop loss that far away. So that's where the maximum stop loss setting comes in. So that even if, so instead of, setting it 5,000 points away, it's still just going to set it at 1,000. So if the place that the software is going to place a sell order, calculate that the stop loss should go here. But if this stop loss is actually more than 1,000 points away from the trade, it will move it down to 1,000 points. All right, so not always something you're going to want to use, but that's the explanation of what it's for, so that you do understand that. Now, we went through order size, which is your lot size. If you set it at 0, it's automatically going to calculate that lot size for you based off your risk percentage, your account balance, and where it's going to place the stop loss. We went through profit locks and everything, and the maximum open at once. The time settings, that's all good. We went through the partial closes, that's good. Now, we actually have two options here. So two totally different strategies for when the software will enter the market. Use inside bar breakout. Now, if you watch one of the older settings videos on Volatility Master, this was the way it worked. There wasn't two options. This was how it worked. And I really don't use that one anymore. So that may end up disappearing in the future. But essentially all it means is if you've got a candle and then the next candle's smaller and doesn't go above or below the extremities of the previous candle, then when it breaks above or below that inside candle, the inside candle being the smaller one, that's the way it will trade. So as you can see, I have that turned to false. So we're using the other option, which is the 1 minute range breakout. This will be getting changed and it will be just called using range breakout, because there are settings to change that so it's not 1 minute. You can choose to use, down here we've got range period. we can change that to any range we like. So it's not necessarily just the 1 minute range breakout. So I will remove the 1 minute from the software, and it will just be called use range breakout. And we have that set to true. And that simply means that instead of using a breakout on that inside candle, it's now calculating the top and bottom of the range. Now, depending on what range you've chosen, it could be the 1 minute range, 5 minute range, 1 hour range, whatever you like, which it's calculated here. Once it actually breaks below or breaks above it, then that's the final final piece of the puzzle for the trade to actually get taken out. So that's what those two choices are there. Breakout, and I'll go through these settings too. Breakout, it refers to, you know, how I said that the software or market needs to break below or break above the range. The breakout setting is how far it needs to break below or above. And in this case, we're using 75 points. Now, to delve into that setting a little bit more, the higher you set this figure, the more definite that breakout needs to be. But if you make it too far, it will never actually hit it. Because, you know, if it goes below this blue line and then it doesn't quite make it to the breakout figure within the next 4 candles, then that range is going to change and you have to start trying to break below it again. Yeah, so if you've got that set too high, you'll probably find you won't get any or very many trades. You know, it'll look like it's broken below when you should have got a trade, but you don't actually get it. That could well be because of that setting. Something that will change depending on your pair as well. You know, indices is a higher figure just by the way they're calculated. Gold's higher than Forex as well. Different Forex pairs, depending on their volatility, would need to be different as well. Support, resist, buff. That stands for support and resistance buffer. That's nothing that you will see or really use yourself, but that's just one of the settings that the software uses to calculate the top and bottom of the range. You know, so how it's calculating the top and the bottom of the range is it's found this low point, and that's where the bottom of the range is, and it's found this high point, and that's where it's placed the top of the range. Support and resistance buffer, which is what that stands for, adds a little bit of a buffer so that if there are a couple of candles that are slightly higher, in this case 200 points higher than the original calculation for the range, then it will move it up to the top of those as well to include them. So that's what support and resistance buffer is. Basically, nobody's ever going to really play with that too much, but for those that are a little more experimental and hands-on, that's the explanation for what it does. Shoulder. That's how the software is calculating a peak or a trough in this case. So for this to be considered a peak or a trough, the 4 candles either side of it need to be higher. Therefore, it's making a peak trough shape. That's 4. If you set that to 5, then 5 candles either side need to be higher and opposite for the top of the range. Between 3 and 5 is what we use. I mostly always use 4. If you go any less, it's going to give you false peaks. If you go any higher, you'll miss out on peaks that are definitely peaks. Candles, it's only looking at, in this case, the last 50 candles to find the peaks. If the candles are any further to the left, then they're not really going to form part of the calculations to work out the top and bottom of the range. Secpeakpref, so it stands for second peak preference. What it's doing is it's calculating not only one peak, but it would actually calculates, finds 3 peaks. So it's finding 1, 2, 3 peaks, and then it's working out which one it should use. And in this case, second peak preference set at 400. If the second peak, for example, like say this might be 1 peak and this will be 2 peaks. If this peak is more than 400 points away from the first peak, then it won't count it. So it's always finding the most recent peak. But if they're close together, as it is in this case, it's going to use this one. Mitigation. I'm going to save that one for the next video because that's a whole other speech, really. So I'll leave this video here at that, and I'll see you on the third volume. I don't want to make each video too long. That way everyone can just watch one when they get time and then come back to the next one when they get time. But anyway, thanks for listening. Talk to you all again soon.